$1,600,000,000,000. That is the current outstanding auto loan debt in the United States. That number just crossed a record high, and buried inside it are 23 million Americans who owe more on their car than the car is worth on day one. Not after an accident, not after 5 years of depreciation, on the day they drove it off the lot. Here is the number that should make you physically stop what you are doing. The average new car payment in America right now is $737 a month. The average used car payment is $520. And the average loan term, the amount of time people are agreeing to pay those amounts, is now 72 months, 6 years. Do the math. At $737 a month for 6 years, you are committing $53,064 to a machine that will be worth roughly $18,000 when you are done paying for it. That is not a car purchase. That is a $35,000 penalty for needing transportation. And here is what makes this a forensic story. Not just bad luck. None of this happened by accident. The 84-month loan, the payment packing technique, the negative equity rollover, the dealership finance office that makes more money off your financing than off your actual car, these are not the random outcomes of a free market. They are engineered systems, designed by specific people at specific companies to extract the maximum possible amount of money from you while keeping you so focused on the monthly payment that you never notice what is actually happening. Today, we are opening the dealership's back office. We are going to show you exactly how the auto lending trap was engineered, why it has gotten dramatically worse since 2020, and what the only rational moves are if you need a vehicle right now. Welcome to the forensic audit of the auto debt bomb. To understand why car loans written after 2020 are categorically different and more dangerous than loans written in previous decades, you have to understand what happened to the car market between 2020 and 2022. COVID hit. Semiconductor factories shut down. The auto industry, which had been running lean just-in-time inventory for years, suddenly had no chips to put in new vehicles. New car production collapsed. Dealer lots that used to hold 60, 80, 100 days of inventory were down to 10 days, sometimes less. Basic supply and demand took over. When there are 20 buyers for every 3 cars on the lot, prices go up. And they went up dramatically. The average new vehicle transaction price, the amount people actually paid, not the sticker, went from roughly $38,000 in early 2020 to over $49,000 by late 2022. That is a 29% increase in less than 3 years. But here is what makes this period particularly destructive. Interest rates were simultaneously rising. The Federal Reserve, fighting post-COVID inflation, raised the federal funds rate from near zero in March 2022 to over 5% by mid-2023. Auto loan rates followed. The average new car loan rate went from around 4% in 2021 to over 7.5% by 2023. So, in the span of roughly 18 months, buyers were hit with a double punch. The car cost 29% more, and the interest rate on the loan nearly doubled. The industry's solution to this double punch was not to sell fewer cars. It was to extend loan terms. Instead of a 48 or 60-month loan, lenders started aggressively pushing 72-month and 84-month loans, 6 and 7 years, to keep the monthly payment at a number buyers would say yes to. The monthly payment went down. The total cost of the vehicle went up dramatically, and most buyers, trained by decades of payment-focused car advertising, never noticed the difference. This is where the trap was set, and it is still open. Let me tell you about the most important room at a car dealership that the dealer will never voluntarily explain to you. After you negotiate the price of the vehicle with the salesperson, after you have shaken hands on a number and you feel good about the deal you made, you are walked to a different office. A quieter office, usually in the back of the dealership. You sit down across from someone with a different title, not a salesperson. This person is the finance and insurance manager, the F&I manager. And this is where the real transaction happens. Here is what most car buyers do not know. At the average dealership in America, the finance and insurance office generates more gross profit per vehicle than the sale of the vehicle itself. A 2022 National Automobile Dealers Association report found that F&I profit per new vehicle retailed averaged over $1,800. often more than the front-end profit on the car. How does a finance office make $1,800 on a transaction where you are just signing loan paperwork? It starts with the interest rate. When you finance through a dealership, the dealership is not the lender. They are a broker. They take your credit application, send it to banks and captive finance companies like Ford Motor Credit or GM Financial, and those lenders come back with an interest rate they will approve you at. Let's say the bank approves you at 6.5%. The dealership is legally permitted, in most states, to mark that rate up before presenting it to you. They might show you 8.5% instead of 6.5%. They keep the spread. On a $40,000 loan over 72 months, that 2% markup is worth approximately $2,400 in additional interest payments out of your pocket, directly into the dealership's revenue. This practice is called dealer reserve, and it is entirely legal, and it is almost never disclosed to you. Then come the add-on products. Extended warranties, often called vehicle service contracts, marked up 300% from their actual cost. Paint protection packages, gap insurance, which can be purchased for a fraction of the dealership price through your own insurance company. Tire and wheel protection. These products are not inherently fraudulent, but the markup on them is extraordinary, and the F&I manager is professionally trained through industry certification programs, to present them in a way that makes declining feel financially irresponsible. The technique is called four-squaring, a negotiation framework that deliberately creates confusion by mixing the trade-in value, the purchase price, the monthly payment, and the loan term into a single negotiated package. By keeping all four variables in place simultaneously, the F&I manager can appear to give you a concession in one area while quietly taking it back in another. You get $500 more on your trade-in and somehow end up with a higher monthly payment on a longer loan. This is not a rogue employee. This is a trained, certified profession with its own trade association and its own continuing education curriculum. The system is working exactly as designed. Now, we need to talk about the mechanism that turns a single bad car loan into a generational debt trap. It is called negative equity, and the industry's internal term for it is being upside down on your vehicle. Negative equity means you owe more on your car loan than the car is worth. And because of how aggressively vehicles depreciate, a new vehicle loses roughly 20% of its value in the first year of ownership. Almost every new car buyer on a long-term loan enters negative equity within months of purchase. On a 60-month loan at reasonable interest rates and a normal vehicle price, this was manageable. The depreciation curve and the loan paydown curve would cross somewhere around the 24 to 30-month mark, and the buyer would return to positive equity before they were typically ready to trade vehicles. On a 72 or 84-month loan at 7.5% interest on a vehicle that was already 29% overpriced relative to 2019 norms, that crossing point moves out dramatically. Many buyers on these loans will be underwater for the entire loan term. Here is where it becomes a trap rather than just a bad outcome. Most Americans trade vehicles every 3 to 4 years, not every 6 to 7 years. When a buyer with $8,000 in negative equity walks into a dealership to trade in their vehicle, the dealer has a solution. They will roll the negative equity into the new loan. Your $8,000 deficit disappears from the paperwork on the old car and reappears quietly in the financed amount on the new car. The buyer leaves feeling like they got a fresh start. What they actually got was a new 72-month loan on a $45,000 vehicle, where $8,000 of that financed amount is not the new car. It is the ghost of the old car they thought they traded away. Do this twice, and you are carrying $15,000 to $20,000 of compounding negative equity debt disguised as a car payment. The Consumer Financial Protection Bureau has documented cases of buyers with $25,000 in rolled negative equity, meaning they are financing more in phantom debt from previous vehicles than they are financing the actual car they are driving. This is not an edge case. In 2023, more than 1 in 4 trade-ins carried negative equity. The average negative equity amount on those trade-ins was $6,054. These are not people who made one mistake. These are people who were never told how the system worked. There is a specific dealership practice that is so predatory it has been the subject of Federal Trade Commission investigations, state attorney general actions, and consumer protection legislation in multiple states. It is called yo-yo financing, and if it has happened to you, you will recognize it immediately. Here is how it works. You go to the dealership, you negotiate the price, you complete the F&I paperwork, and you drive home in your new vehicle. The deal feels done. You might have the car for a few days, maybe a week. You show your family. You park it in your driveway. Then the dealership calls. They tell you there was a problem with your financing. The lender fell through. The numbers changed. You need to come back in and sign new paperwork. When you come back, the new deal has different terms. A higher interest rate, a larger down payment requirement, or both. You are now sitting in the dealership with your trade-in already processed and sold, your old insurance policy already changed, and a new vehicle sitting in your driveway that the dealer knows you have emotionally committed to. You are at maximum negotiating disadvantage, and they know it. Most buyers sign the worst deal rather than unwind the entire transaction. The Federal Trade Commission documented this practice extensively in a 2023 report and subsequently proposed rules to ban bait-and-switch financing disclosures. The key word is proposed. As of this recording, yo-yo financing remains legal and practiced in the majority of states. The mechanics that enable it are straightforward. Dealerships in most states are permitted to deliver vehicles on spot delivery, meaning you take the car before the financing is fully finalized with the lender. The dealer has a contractual out if the financing falls through. That out is supposed to be a protection for the dealer against lender rejection. In practice, it is used as a customer renegotiation tool. Everything we have covered so far is the anatomy of how the system is designed to work against you. Now we are going to talk about how to use the system's own structure against it. Move 1. Get pre-approved before you set foot on a lot. Go to your credit union or your bank before you visit a dealership. Apply for a pre-approved auto loan. Get the approval letter. Walk onto that dealership lot knowing exactly what interest rate you have already secured and exactly what maximum loan amount you are working with. This single step dismantles the F&I office's primary leverage over you. The dealer can still offer financing, and you should let them. If they can beat your pre-approved rate legitimately, take it. But you are now negotiating from a position of information parity, not information asymmetry. The dealer reserve markup cannot happen if you already know what rate you qualify for. Credit unions specifically deserve emphasis here. The average auto loan rate at credit unions consistently runs 1.5 to 2.5 percentage points below the average rate at commercial banks and captive finance companies. On a $40,000 loan over 60 months, that spread is worth $1,800 to $3,000 in total interest savings. The approval process at most credit unions is identical to a bank application and takes the same amount of time. Move 2. Negotiate the price, not the payment. The single most effective negotiating discipline you can apply is to refuse to discuss monthly payments during price negotiation. When a salesperson asks, "What monthly payment are you comfortable with?" the correct answer is, "I'm not negotiating payments. I'm negotiating the out-the-door price of the vehicle." The out-the-door price is the total vehicle price plus taxes plus dealer fees before financing. Once you have agreed on that number, the financing is a separate, subsequent conversation. By keeping them separate, you prevent the four-squaring technique that blends them into confusion. Move 3. Understand your actual loan before you sign it. The 3 numbers that matter on any auto loan document are the vehicle selling price, the APR, annual percentage rate, not the interest rate, and the total of all payments. That last number, total of all payments, is the real cost of the vehicle. On a $40,000 vehicle financed at 7.5% for 84 months, the total of all payments is approximately $52,800. You are paying $12,800 in interest to own that vehicle. If that number isn't on the paperwork in front of you before you sign, ask for it explicitly. Move 4. On the used market, the math has shifted. The 2020 to 2022 supply shortage that inflated new vehicle prices also inflated used vehicle prices to extraordinary levels. That bubble is now deflating. used vehicle prices have come down 15 to 20% from their 2022 peaks in most segments. For buyers who are not committed to a specific new model, the 2019 to 2021 model year range in reliable, non-turbocharged platforms now represents genuine value. Vehicles that were overpriced during the bubble but are returning to rational valuations with the added benefit of the initial depreciation already absorbed by the first owner. Specifically, a 2019 to 2021 Toyota Tundra with the 5.7-liter V8, a 2018 to 2021 Honda Ridgeline, or a comparable non-turbocharged platform in that window. Purchased with a credit union pre-approval, negotiated on out-the-door price on a 48 or 60-month term, is a fundamentally different financial transaction than a new vehicle financed at a dealership on an 84-month term. The gap between those two transactions over the life of the loan is often $15,000 to $25,000 in real money. That is not a rounding error. That is a year of mortgage payments for many American families. Here is the verdict. The auto lending industry between 2020 and today has produced the most dangerous combination of factors in the history of consumer vehicle financing: inflated vehicle prices, rising interest rates, extended loan terms, and an F&I infrastructure that has been professionally refined over decades to extract maximum revenue from buyers who walk in underprepared. The result is $1.6 trillion in outstanding auto debt, record delinquency rates, and 23 million Americans who are underwater on vehicles they are still paying for. None of the people caught in these loans are stupid. They are people who weren't told that the dealership finance office is a profit center. They weren't told about dealer reserve markups. They weren't told that their $8,000 in negative equity was rolling silently into their new loan. They weren't told that the total of payments on that 84-month deal was $52,000 on a $40,000 car. They weren't told because the system depends on them not knowing. The counter to an information asymmetry system is information. Get pre-approved. Know your out-the-door price. Know your total of payments before you sign. Understand what negative equity is and refuse to roll it. And seriously consider whether the used vehicle market right now offers a more rational entry point than anything currently sitting on a new car lot. The auto industry has been selling transportation for 100 years. They are very good at it. They are also very good at making a financial trap feel like a fresh start. Know the difference. If this forensic audit helped you, share it with someone who is currently car shopping. The information in this video could be worth $10,000 to $20,000 to them in real out-of-pocket money. And subscribe, because every week we are opening another room that the industry doesn't want you to see inside. See you in the next audit.